The 2025 car market has collapsed, and these 9 brands won't survive to 2026 because what's happening to the automotive industry right now is the biggest financial disaster since the 2008 crisis, and it's happening faster than anyone predicted. Picture car brands that have defined roads for over a century suddenly facing extinction. Factories that employed entire cities are shutting down permanently. Dealerships that sold millions of vehicles are closing their doors forever, and the brands you grew up trusting are writing their final chapters in real time. But here's what's really shocking the industry. The collapse isn't just about electric vehicles or changing consumer habits. There's a hidden financial crisis brewing, a perfect storm of supply chain disasters, debt spirals, and a secret factor that is targeting specific brands for total elimination while others somehow survive. The most damning evidence came from leaked internal documents showing that some of these 9 brands knew they were doomed months ago, but kept selling cars to unsuspecting customers, knowing full well they would not be around to honor warranties or provide parts when those vehicles inevitably break down. Which 9 car brands are already writing their obituaries, and are we watching the death of the automotive industry as we know it? Or just the beginning of a market consolidation that will leave only a few mega corporations controlling what we drive? 16,300,000 new cars were sold in the United States in 2025. That is the highest total since 2019, and a figure that seems to defy the word collapse splashed across headlines and social feeds. Even as factories face raw material shortages and tariffs, buyers still lined up for new vehicles, driven by pent-up demand, a strong stock market, and the simple need to get to work. Globally, automakers built 78 million light vehicles this year, a 1.6% drop from 2024. North America's production shrank by just over 5%, while Europe lost about 2.5%. The contraction is real, but it is measured in single digits, not free fall. The picture shifts in the final quarter. December's selling rate fell to 15.9 million, down from 16.8 million the year before. Tariffs on Canadian and Mexican imports, in effect since February, raised costs for every major brand. Ford reported a $1 billion hit from tariffs alone. Stellantis, owner of Chrysler and Dodge, posted a net loss of $2.7 billion in the first half of the year. A fire at the Novelis aluminum plant in New York, supplying 40% of the nation's auto aluminum, halted production and idled Ford's F-150 lines, the country's best-selling truck. Inventory piled up as supply chains buckled, and dealers slashed prices on leftover 2024 models to clear room for incoming 2026 stock. Electric vehicles, once seen as the market's savior, hit a wall after federal tax credits expired in October. Battery electric car sales soared in the third quarter, then plunged by double digits as incentives vanished. GM's US sales rose 5% to more than 2.8 million units, capturing 17.3% of the market. Toyota's share climbed to 15.5%, up 8.4% from last year. Ford and Hyundai joined them, gaining ground while others struggled. The top 4 brands together expanded their lead by nearly 3 points, while smaller and less diversified players lost ground. Stellantis cut North American production by nearly 1/5. Tesla's output dropped by almost a quarter. Looking ahead, forecasts call for U.S. sales to slip to 15.8 million in 2026, a modest decline, not a collapse. Industry analysts describe the current environment as a recalibration, not a repeat of 2008. The numbers show stress, not extinction. Under the surface, though, the cracks are spreading. The next chapter will reveal whether these are growing pains or something far more dangerous for the brands on the brink. Charlie Chesbrough, senior economist at Cox Automotive, described the outlook for 2025 as an otherwise bright forecast. Heading into the year, industry analysts expected relief on affordability, with the Federal Reserve poised for rate cuts and credit gradually loosening. The only real weak spot, they said, would be certified pre-owned vehicles, hamstrung by a shrinking pool of off-lease cars. Most experts agreed the new car market was healthy, demand was solid, and the worst of the pandemic supply shocks seemed to be behind us. But beneath the surface, unease lingered. Affordability remained the market's biggest challenge. New vehicle prices hovered near record highs, with the average transaction pushing $50,000 and monthly payments for many buyers stuck above $700. At the same time, auto loan debt in the United States soared past $1.6 trillion, outpacing student loans for the first time. 1 in 4 trade-ins arrived with negative equity, owners owing more than their cars were worth, often by nearly $8,000. Repossessions, which had already jumped from 1.5 million in 2023 to 1.75 million in 2024, were on pace to hit 3 million by year's end. That is nearly double the pre-pandemic rate, flooding used car lots and putting extra pressure on dealers to move new inventory at any cost. For the industry's biggest players, these cracks looked manageable. GM, Toyota, Ford, and Hyundai all gained market share, using incentives and deep pockets to pull buyers in. For smaller brands, however, the picture was different. Tariffs on Canadian and Mexican imports raised sticker prices and squeezed margins, especially for companies with less domestic production. The fire at Novelis's aluminum plant left entire product lines idle. Expired electric vehicle tax credits caused electric car sales to plunge, leaving manufacturers with unsold inventory and slashed forecasts. Industry commentary in early 2025 leaned toward optimism, but the data painted a more complicated picture. Cox Automotive's forecast called for improvement, yet acknowledged that affordability and credit access would remain stubborn obstacles. Meanwhile, the stream of repossessions, rising negative equity, and mounting debt signaled that the risks were not just theoretical. As the year wore on, it became clear that the questions were not about whether the market would survive, but which brands could weather the storm as the ground shifted beneath their feet. Across the country, the car dealership network is shrinking in ways that would have seemed unthinkable 2 decades ago. Since 2007, the number of Ford, General Motors, and Stellantis dealerships has fallen by nearly 39%, dropping below 20,000 rooftops nationwide. For some brands, the pace is even faster. Buick closed almost 900 locations in 2023 alone, leaving just over 1,000 left by 2025. Chrysler and Dodge, once mainstays in small towns, now see fewer than 100 cars sold per store, making it impossible to keep the lights on for many family-run franchises. Mike grew up in the business. His father opened their dealership in 1972, back when every county seat had a Chevy, Ford, or Chrysler sign out front. By 2025, Mike's showroom sits empty most days. Inventory is thin, foot traffic has dried up, and the service bays echo with the memory of busier times. He has watched neighbors close their doors, forced out by new capital requirements from automakers and the relentless rise of online sales. The network contraction is not just a matter of lost logos. It means jobs gone, tax revenue erased, and communities left without a local anchor. In California, new car dealers paid over $9 billion in state sales tax in 2024, with each store averaging more than $6 million in contributions. When a dealership shutters, that money vanishes from city budgets, school districts, and public works projects. The losses ripple beyond the sales floor. Every closure puts dozens of mechanics, salespeople, and office staff out of work. Local suppliers, tire shops, insurance agents, even restaurants feel the pinch as business disappears. For Mike, the hardest part is not the shrinking profit margins or the empty lot. It is watching a business that once defined his town fade into the past, taking with it the sense of stability that generations counted on. Dealer networks built the backbone of America's car culture, Their slow erosion leaves entire regions vulnerable long before any headline-grabbing collapse. Mike's dealership once buzzed with life. Now, the only sound most mornings is the hum of a vending machine in the break room. His cousin Lisa handled payroll for nearly 30 years, but she was let go last spring, one of 12 employees who lost their jobs when the showroom stopped moving cars. The service manager, Tony, started delivering packages for a courier service to make ends meet. The town's tire shop, which relied on steady business from warranty work, closed its doors in July. Down the street, the diner that hosted sales meetings now sits empty at lunchtime. The losses pile up in quiet ways. The city's annual 4th of July parade, always sponsored by local dealers, was canceled for the first time in decades. School administrators postponed a new playground project after sales tax revenue came in lower than expected. The fire department's plan to replace an aging truck was shelved indefinitely. For many, the dealership was more than a business. It was a place where people built careers, where families bought their first cars, where teens landed their first summer jobs. As each closure ripples through the community, the sense of belonging disappears alongside the paychecks. Mike spends his afternoons calling old customers, hoping to keep the service bay open a little longer. But with parts harder to find and fewer cars on the road, even longtime clients are forced to look elsewhere. The town's identity, once tied to the brands on the sign out front, now feels unmoored. The collapse is not measured in sales charts or market share. It is felt in empty parking lots, shuttered storefronts, and the quiet resignation of neighbors who once believed the dealership would always be there. Tariffs hit the car market like a sledgehammer in 2025. Tariffs reshaped costs overnight. A 25% duty on Canadian and Mexican imports took effect in February, instantly raising costs on everything from engines to seat frames. Brands that relied on cross-border parts saw their margins evaporate overnight. Ford calculated a $1 billion loss from tariffs alone before summer even started. Stellantis, already reeling from weak sales, reported a $2.7 billion net loss in just 6 months. The price hikes filtered down to every showroom, but smaller brands and dealers felt the pain most. For them, every extra dollar meant another customer lost to the giants who could absorb the shock. Then came the fire. On September 16th, a blaze tore through the Novelis aluminum plant in Oswego, New York. This single facility supplied 40% of all the aluminum used in American auto manufacturing. Flames gutted production, and by dawn, Ford's F-150 lines sat idle. The country's best-selling truck, suddenly frozen in place, was waiting on metal that would not arrive for months. Other factories scrambled to find alternative suppliers, but the logistics nightmare sent ripples through the entire industry. Inventory started to pile up, with unfinished vehicles clogging lots and warehouses. Dealers slashed prices on leftover 2024 models, desperate to move metal before the next wave of uncertainty arrived. Material shortages collided with tariff-driven cost spikes, creating a perfect storm. The cost to build a car soared, but the price customers were willing or able to pay did not keep up. Executives issued profit warnings, but on the ground, it was the workers who felt the impact first. Shifts were cut, overtime vanished, and the promise of steady paychecks faded. In towns that depended on auto jobs, the anxiety was palpable. The shockwaves from policy decisions and a single factory fire left thousands wondering if their livelihoods would survive the year. Anna's last day at the assembly plant began with a message from her supervisor telling her not to come in and to check her email. She had worked on the line for 12 years, building SUVs that once rolled out by the hundreds every shift. Now the parking lot was half empty, and the break room was filled with silence instead of laughter. When the layoffs came, Anna's name was on the list, one of 2,000 workers cut from a single site after an aluminum shortage stalled production. Her severance barely covered 2 months' rent. She packed her locker and left behind a job that had paid for her daughter's braces and her father's heart surgery. Across the country, the story repeated itself. Shifts were cut at Ford's Kentucky truck plant. Temporary workers were let go at Stellantis facilities in Michigan and Ohio. At some plants, entire departments vanished overnight. The ripple effects stretched beyond the factory gates. Cafeterias closed. Shuttle drivers lost contracts. Local landlords faced empty apartments as families moved away in search of work. For every layoff, dozens more in the community felt the aftershock. In the boardrooms, the mood was no less tense. Ford chief executive Jim Farley described the year as one of a lot of cost and a lot of chaos. Executives scrambled to revise forecasts, slash expenses, and reassure investors. At Stellantis, leadership issued a memo warning that North American operations were under review, a phrase that sent chills through plants already running on skeleton crews. The pressure to deliver profits in a market battered by tariffs and supply shortages forced companies to make brutal choices. For workers like Anna, the sense of security that once came with a union card was gone. Friends who had clocked in together for decades now compared job listings and worried about health insurance lapsing. The pride in building America's cars gave way to anxiety over paying bills. As layoffs swept through towns built around the auto industry, the human cost of the market's turmoil became impossible to ignore. For executives, every decision carried a double edge. Cut too deep, and they risked losing the skilled workforce needed for recovery. Hold on too long, and the company's balance sheet would bleed red. The collision of corporate strategy and working-class reality turned the industry's recalibration into a crisis that left no one untouched. Auto loan debt in the United States crossed $1.65 trillion in 2025, outpacing even student loans for the first time. That debt is not just a number on a spreadsheet. It is a daily burden for millions of drivers. The average new car payment now stands at $750 a month. For used cars, it is $525. Nearly 1 in 5 new loans stretches out for 7 years or more, locking buyers into payments that outlast the shine on their vehicles. For many, the math just stopped working. 25% of trade-ins arrived at dealerships with negative equity. That means nearly 2 million drivers handed over keys to cars worth less than what they owed, often by almost $8,000. The cycle feeds on itself. People roll old debt into new loans, stretching their budgets thinner with every trade. Repossessions surged to levels not seen since the aftermath of the Great Recession. In 2023, lenders reclaimed 1.5 million vehicles. That number climbed to 1.75 million in 2024. By the middle of 2025, repossessions had already hit 2.2 million, with projections pointing to 3 million by year's end. Every day, tow trucks sweep through neighborhoods, collecting cars from driveways and parking lots. Auctions fill with vehicles whose owners could not keep up with the payments. This wave of repossessions is flooding the used car market, pushing prices down and leaving dealers scrambling to clear out aging inventory. Wholesale values dropped as supply outpaced demand, forcing sellers to take losses on cars they once marked up with confidence. Incentives returned to levels last seen in 2021, as manufacturers tried to lure buyers back with cash offers and 0% financing. But for many, even those deals could not offset the weight of existing debt. The fallout is not limited to buyers. Lenders face mounting losses as the value of repossessed cars fails to cover loan balances. Dealers, caught between shrinking margins and rising floor plan costs, watch profits evaporate with every unsold vehicle. The scale of the crisis is measured not just in dollars, but in lives disrupted, families losing transportation, businesses losing customers, and communities losing the steady hum of commerce. The numbers tell the story: 3 million repossessions, $1.65 trillion in auto debt, and a market where affordability is slipping further from reach. The chain reaction starts quietly. A family misses a car payment. Another rolls thousands of dollars of old debt into a new loan, hoping the next model will last longer than the monthly bills. But as interest rates climb and wages lag behind, more drivers find themselves underwater, owing far more than their vehicles are worth. By late 2025, 1 in 4 trade-ins arrives at auction with negative equity, each car a symbol of promises broken and budgets stretched to the breaking point. Every day, tow trucks haul away cars from driveways and apartment lots. Repossessions push toward 3 million for the year, nearly double the levels seen before the pandemic. The auction yards swell with vehicles, each one a story of a family forced to choose between groceries and a car note. Dealers, already struggling with thin margins, watch as the flood of repossessed cars drives down wholesale prices. Wholesale values tumble, and what used to be a steady stream of profit turns into a scramble to cut losses before the next wave hits. The stress spreads up the chain. Lenders absorb mounting losses as the value of repossessed cars fails to cover outstanding loans. Dealers who once relied on quick sales now face inventory that sits unsold for weeks. Incentives pile up, cash offers, 0% financing, anything to keep cars moving off the lot. But for many buyers, even these deals cannot erase the weight of old debt. The cycle repeats. Negative equity leads to longer loans. Longer loans lead to higher repossessions. And each repossession adds to the mountain of used inventory that no one really wants. For the weakest brands, this is a death sentence. Smaller automakers and their dealers, already squeezed by tariffs and supply shortages, cannot weather the storm. When consumers lose confidence in a brand's future, when they fear a warranty will be worthless or parts impossible to find, they walk away. Auctions fill with unsold models from brands teetering on the edge, their badges a warning sign for anyone thinking about taking the risk. The market does not collapse all at once. It erodes from the bottom up, one repossession, one auction, one shuttered dealership at a time. The survivors are those with the resources to outlast the storm, but for the most vulnerable, the end comes quietly, in the hum of an auctioneer and the silence of an empty showroom. Fisker's story reads like a warning for every upstart in the electric car race. In June 2024, the company filed for Chapter 11 bankruptcy after missing an $8.4 million bond payment. More than 70% of Fisker's Ocean SUVs were caught up in recalls, with some owners waiting months for replacement parts that never arrived. By the time SEC filings admitted survival was unlikely past the summer, service centers had already started closing. For buyers, the reality was harsh. Cars stranded without support, warranties in limbo, and resale value evaporating overnight. Polestar, once hailed as a challenger to Tesla, watched its market value collapse by 83% since its 2022 peak. In July, a leaked supplier email surfaced, and shipments were halted over overdue invoices. Owners reported months-long waits for battery and software modules, with no clear timeline for fixes. Recalls piled up, and back-ordered parts left cars sidelined. The promise of high-tech Swedish engineering faded as support networks thinned and confidence drained from the brand's future. Jaguar, under Tata Motors, faces a mountain of debt, £2.75 billion due within 18 months, and a monthly burn rate that outpaces revenue. New sales in the United Kingdom were halted in 2023, and rumors swirled about missed payments to suppliers and the possible sale of the Whitley campus. For a brand that once defined British luxury, the prospect of a forced retreat from global markets hangs over every boardroom meeting. The numbers are stark, and the timeline is short. Nissan's global losses reached $5.3 billion in 2024, with U.S. operations alone accounting for $3.5 billion of the red ink. Cash reserves dipped below $11 billion, while the company faces $25 billion in net debt and $6.4 billion in bonds coming due by 2026. Anonymous executives told reporters the company had less than 14 months to execute a turnaround. Infiniti, Nissan's luxury division, is under active review, with some dealers reporting losses of up to $2 million and rumors of a full-scale exit from the U.S. market if sales do not recover. Stellantis, the sprawling conglomerate behind Chrysler, Dodge, Jeep, and Ram, is fighting a war on several fronts. North American production is down nearly 20%, and the company posted a $2.7 billion net loss in the first 6 months of 2025. CEO Carlos Tavares was forced out amid boardroom turmoil, and speculation runs rampant about a possible spin-off or dissolution of the Chrysler brand if losses continue. Suppliers have demanded cash up front, and the Auburn Hills headquarters is reportedly up for sale. In a memo to employees, Stellantis leadership warned that not every brand in the portfolio is guaranteed to survive past 2026. Each of these brands faces its own storm: missed payments, shrinking sales, mounting debt, and the slow unraveling of dealer and supplier relationships. The headlines may talk of recalibration, but for employees and owners, the threat is immediate and personal. The next 5 brands face a similar reckoning, with the clock ticking and options running out. Infiniti, Nissan's luxury badge, now faces a crossroads. United States sales have slipped below 60,000 units this year, a far cry from the 6-figure heights of a decade ago. Dealers, once eager to invest in glass-walled showrooms, are quietly absorbing losses. Some report being down nearly $2 million since 2023, with rumors swirling of a full exit from the American market if numbers do not rebound. Nissan's global losses, over $5 billion last year, cast a long shadow. And with $25 billion in net debt and major bonds coming due by 2026, the company's ability to prop up Infiniti is under constant review. No internal memos have surfaced to confirm a retreat, but every quarter of red ink deepens the uncertainty. Chrysler, one of Detroit's storied names, now teeters on the edge of irrelevance. Stellantis, its parent, posted a $2.7 billion net loss in the first half of 2025. Chrysler's United States sales hover just above 100,000 units, and at the average store fewer than 100 vehicles move each year, barely enough to justify keeping the lights on. Suppliers have begun demanding cash up front, and whispers of a spin-off or outright closure grow louder with every earnings call. The Auburn Hills headquarters, once a symbol of American automotive ambition, is rumored to be for sale. For the small towns that once rallied around the Chrysler brand, the prospect of losing their last dealership feels both unthinkable and inevitable. Mitsubishi's retreat has been quieter, but no less dramatic. With a market share that barely registers, United States sales have fallen to their lowest point in decades. The brand has pulled back from major regions, closing stores and shrinking its product lineup. Dealers talk of factory support that has thinned to a trickle. No official announcement has come, but the pattern is clear: fewer models, fewer stores, and a future that looks more like a managed withdrawal than a turnaround. Dodge, long known for muscle cars and bold branding, now sits on industry watch lists. Its reliance on large, fuel-hungry vehicles makes it especially vulnerable in an era of tightening emissions rules and shifting consumer tastes. While no bankruptcy filings or leaked documents have landed in public view, analysts point to shrinking volumes and a lack of new product investment as warning signs. Dodge's future, like Chrysler's, depends on decisions made in Stellantis boardrooms, where survival is no longer guaranteed for every badge. For these brands, there is no smoking gun. No leaked memo spells out the end. What remains is a landscape shaped by public filings, sales charts, and the slow erosion of confidence. The rumors of a hidden financial crisis are just that, rumors. The real story is written in dwindling sales, mounting debt, and the relentless pressure of a market that rewards only the strongest. Industry analysts now weigh the possible outcomes. Some warn that a recession, combined with persistent tariffs and rising repossessions, could push weaker brands over the edge, triggering a wave of closures and consolidation not seen since the Great Recession. Others see a more measured path, incentives and price cuts, a gradual thinning of dealer networks, and a slow fade for brands that cannot keep pace. The most optimistic voices point to a market that has proven resilient before, where innovation and deep pockets can buy time for reinvention. A sober view comes from industry observers tracking this storm. We are beyond that breaking point. Something has got to give very soon. That warning from a leading analyst captures the unease rippling through boardrooms and factory floors alike. For the brands still standing, the next year will decide whether they adapt or vanish, leaving the roads and the industry changed for a generation. Right now, the auto industry stands on uncertain ground, reshaped not by a single collapse, but by relentless disruption and debt. As production slows and tariffs bite, the fate of legacy brands hangs in the balance while mega corporations tighten their grip. For drivers and workers alike, the promise of choice and stability is no longer guaranteed. The real question is, who decides what we drive next, and at what cost? Share your thoughts below.